Welcome back to Deep Thought Productions. Today we're taking a deeper look at XRP because the latest numbers are sending some very different signals. In the last 48 hours, the conversation has shifted away from simple bullish headlines and toward a much more interesting question. Why are large XRP holders accumulating while the price remains trapped close to the critical $1 level? At the same time, ETF demand remains positive, but the pace has slowed dramatically. Leverage is rebuilding, network activity is improving, and regulatory uncertainty is still hanging over the broader market. So rather than simply asking whether XRP is bullish or bearish, we're going to examine what the data is actually telling us. The first number to watch is $1. Recent market coverage shows XRP falling toward roughly $1.02 before recovering, putting the token extremely close to a psychological level that traders have been watching for some time. What makes this important is not simply the round number. If XRP remains above $1, buyers can argue that the recent weakness is still a consolidation rather than a breakdown. But if the market decisively loses that level, traders could begin treating the move as a change in structure rather than another routine pullback. That distinction matters because sentiment tends to change very quickly when a heavily watched support level fails. For now, $1 is acting less like a prediction and more like a market test. Now we get to one of the most interesting developments. According to data cited from Sentiment, large XRP holders accumulated more than 380 million XRP over the past week, taking their combined holdings to around 8.13 billion tokens. That is significant because the price has not responded with a comparable breakout. Normally, heavy accumulation accompanied by rising prices would be an obvious bullish signal, but accumulation while price remains weak creates a divergence. There are two ways to interpret it. One possibility is that larger holders are using the current weakness to build positions because they believe the $1 area offers attractive long-term risk and reward. The other is that accumulation alone is not enough to overcome broader market selling pressure. The important point is this: whale buying is evidence of positioning, not proof of a future rally. That leads to the bigger question. If large holders are accumulating, why isn't the market moving higher? One explanation is that demand is being absorbed by selling elsewhere. The latest market analysis shows XRP still struggling against broader relative weakness, particularly when compared with Ethereum. The XRP to Ethereum ratio has fallen sharply recently, suggesting capital is rotating toward assets currently showing stronger momentum. This is an important distinction. XRP doesn't trade in isolation. Even if XRP-specific fundamentals improve, investors can still move capital into Bitcoin, Ethereum, or other assets if they believe those markets offer better short-term opportunities. So the whale accumulation story should be viewed alongside relative performance. Large holders may be positioning for a future recovery, while shorter-term traders are still choosing other parts of the market. The institutional picture is more nuanced than the headlines suggest. Spot XRP ETFs have recorded a fourth consecutive positive week, which means the broader institutional demand story has not disappeared. But there is an important catch. The latest inflow figure is only around $1 million. That compares with much stronger flows seen during earlier periods, while Bitcoin and Ethereum products have recently attracted substantially larger amounts of capital. So technically, the ETF trend remains positive. But the momentum has weakened, and this is one of the most important distinctions investors should understand. A positive flow number does not automatically mean strong demand. It can simply mean that buying exceeded selling by a small amount. For XRP, the question now is whether ETF demand can accelerate again and become large enough to influence the spot market more meaningfully. There is another factor that could make the next move much more volatile: leverage. Recent CoinGlass data cited in market analysis places XRP open interest around $2.5 billion. That means a significant amount of futures positioning has returned to the market. This matters because leverage can amplify movements in either direction. If XRP holds support and prices begin moving higher, leverage traders can add fuel to the upside. But if $1 breaks, those same leverage positions can become forced sellers. That creates the possibility of a liquidity sweep, where falling prices trigger liquidations, which create more selling, which pushes prices lower again. In other words, the market isn't simply deciding whether XRP goes up or down. It is also rebuilding the conditions that can make the eventual move much faster. But there is another side to the story. Recent analysis reports that XRP Ledger 7-day average active addresses have increased by around 8.1%, reaching approximately 15,200 daily active addresses. That is important because price can sometimes tell a very different story from network activity. If fewer people were using the ledger while the token was falling, the bearish case would become easier to understand. Instead, the latest figures show activity moving in the opposite direction. That doesn't guarantee higher prices. Network usage does not automatically translate into token demand, and active addresses can represent many different types of activity. But it does provide evidence that the underlying network is not simply going dormant while price struggles. For investors, this is one of the more useful data points to monitor because it measures activity rather than sentiment. There is also a small but interesting supply-side signal. Recent analysis of XRP ledger data shows that approximately 95,000 XRP have been burned over the measured period, equivalent to only a few hundred XRP per day. That number needs to be put into perspective. It is tiny compared with XRP's overall supply, so describing these burns as a major supply shock would be misleading. The value of the metric is different. It demonstrates that XRP's transaction mechanism continues to remove small amounts of XRP from circulation. For the short-term price, the effect is negligible. For the long-term network economics, however, it is another metric worth tracking alongside transaction activity, liquidity, and institutional usage. This is exactly why the burn figure should be treated as supporting data rather than the central investment thesis. Then there is Washington. The recent delay surrounding the Clarity Act has removed some of the immediate regulatory momentum that crypto investors had been watching. For XRP, the significance is broader than the token itself. A clearer federal framework could influence how exchanges, institutions, asset managers, and financial companies approach digital assets. But the current delay means investors have to wait longer for that clarity. And this helps explain some of the hesitation in the market. Even with ETF products available and network activity improving, regulatory uncertainty can still make institutions more cautious about increasing exposure. The important takeaway is that the delay does not automatically mean a negative regulatory outcome. It means the timetable has become less certain. Put all of these numbers together and an unusual picture emerges. Whales are accumulating, ETF flows remain positive, XRPL active addresses are rising, XRP is still hovering around the $1 region. But ETF inflows have slowed, relative performance has weakened, leverage is rebuilding, and regulatory uncertainty remains. That is not a clean bullish setup, it is a market in conflict. Longer-term participants appear more comfortable accumulating at current prices, while shorter-term capital is demanding stronger momentum before committing aggressively. This distinction could explain why XRP feels unusually stagnant despite several apparently positive fundamentals. The market is waiting for one side of that equation to win. Either demand becomes strong enough to force price higher, or the $1 floor gives way and the defensive positioning becomes dominant. So what would actually change the picture? First, XRP needs to establish that $1 is genuine support rather than temporary support. Second, ETF inflows need to move materially higher. A few $1 million of weekly demand is unlikely to create sustained upward pressure by itself. Third, the market needs to see leverage increase without immediately producing another liquidation event. And finally, stronger network activity needs to continue. If those factors begin moving together, the bullish argument becomes much more convincing. But there is an equally important bearish scenario. If XRP loses $1 while open interest remains elevated, traders could see another wave of forced selling. That is why watching only the price chart misses much of the story. The positioning underneath the price may ultimately determine how violent the next move becomes. The bigger picture is therefore more complicated than either extreme. This is not evidence that XRP is about to collapse. It is also not evidence that a major breakout is guaranteed. What the latest information shows is a market approaching an important decision point. Large holders are positioning. The network is still showing activity. ETF products continue to attract net money, but the size of those flows has weakened, price momentum remains fragile, and leverage has returned to the system. That combination creates an asymmetric environment where relatively small changes in demand could produce a much larger move in price. For viewers following XRP, that is the real story right now. Not a guaranteed target, not a prediction, but a market where the next meaningful move could tell us whether the accumulation we're seeing is early positioning for recovery or simply defensive buying inside a broader period of weakness. For now, the most important level remains $1. Above it, the accumulation, network activity, and continued ETF inflows provide reasons for bulls to remain interested. Below it, rising leverage could make the downside move considerably more aggressive. And perhaps the most interesting signal of all is the divergence between what large holders are doing and what the price is doing. That divergence is worth watching closely. If price eventually responds to the accumulation, the market could interpret it as confirmation that larger investors were positioning ahead of a recovery. If price fails despite that accumulation, it would suggest that the broader market is still too weak for whale buying to overcome. Either way, the next move should give investors much more information than the headlines do today. That brings us to the end of this deeper XRP briefing. The important takeaway is simple. The market is not giving us one clear signal. It is giving us several signals that need to be read together. Price is weak, but large holders are accumulating. ETF demand is positive, but slowing. Network activity is improving, while leverage is building again. And regulatory clarity remains a factor investors are waiting to see resolved. We'll continue tracking the data rather than the hype. Thanks for watching Deep Thought Productions. If you found this analysis useful, hit like, subscribe to the channel, and turn on notifications for the next update.